What a week set up by Wall Street. We will be talking about non-farm data released this Friday and go over some earnings. So be sure to stay tuned so you don't get fooled by some ER report.
This week, I did a workout. Not sure if you're familiar.
I work out often. What is it?
It's called catching hot knives.
That's a good one. I think I know which one you're talking about. We will go over that later too.
Alright, so we have another 238,000 Americans who filed new claims last week, slightly lower than forecast at 245,000.
Continuing claims also fell, and these numbers are telling us that the labor market recovery is doing well from the COVID variant.
We saw a very strong January employment report, which is another positive sign for the economy. The US economy added 467,000 jobs, far exceeding the estimate of 125,000.
The unemployment rate ticked higher, but for a good reason, because more workers are looking to return to the workforce, pushing the labor force participation rate higher to 62.2% from 61.9% in December.
With the current labor market condition and inflation reading, both suggest that the economy no longer needs help, which is why we saw an opening dips on Friday after the non-farm payroll data was released.
A few additional points from the report. The leisure and hospitality sector again saw a healthy gain in payrolls. I guess demand for travel remains strong. Average hourly earnings rose 5.7% year over year.
This is a nice boost for consumer spending and to keep up with the current inflation.
Alright, so here's the takeaway. It's kind of hard for us to see how this bull market will end this year and the economy will fall into recession if the labor market remains healthy. And we think company earnings will be one of the main key drivers of positive market performance this year.
Alright, let's start with your hot knives and go over Facebook earnings. As Zook's company shed over a quarter of its valuation after market on Wednesday.
That's shocking. I didn't think it was going to drop this much. Meta revenues slight beat, EPS miss, forecast miss, daily and monthly active user growth miss. Annual EPS growth is flat and may turn negative. Check out the screen for summary. Looks kind of similar to PayPal, no?
Yup, this is the first quarterly decline in daily active user ever for Facebook. Honestly, I'm kind of surprised this didn't come earlier. Most of my friends don't use Facebook anymore.
Damn, I guess Instagram is still hot. I still use it a lot. And ads on there are still pretty effective to younger audience as they are more inclined to shop on their phone. I have spoken to many of my friends who run ads with Facebook. They're seeing better performances on Instagram side than on Facebook.
Yeah, I see a lot of ads on Facebook now too.
Facebook is expecting 27 to 29 billion for next quarter. That's the forecast missing estimate of 30.15 billion I mentioned before. But the company expects to spend about 90 to 95 billion in 2022, which is lower than forecast of 91 to 97 billion. So that's not bad.
Alright, there are other companies that have pretty much misses across the board. Why did Facebook drop 25%? I was like, what? How did this happen?
So this is likely because the EPS growth is going to be flat for annual growth this upcoming year, or even decline on the single digit point. This is mainly due to the increased expenses in metaverse R&D.
And also, Zook basically said TikTok and other platforms are grabbing its market share of ads. So I believe these two main reasons have investors worried that Facebook might not be a growth name anymore, as their business model mature or even decline. Also, Metaverse will probably take a few years before it really starts blossoming, if it even does. And we all know that investors hate, or rather Wall Street hates, I should say.
Yup, we and Wall Street lack long-term vision and we hate uncertainty. That's likely the main reason Facebook dropped so much. Anyway, as always, let's take a look at some zones for Facebook. And didn't you say you bought the fucking dip?
Yeah, I bought the drop after the ER with 3% of my account. Average around 247. If we use Facebook forecasted number for 2022, we should expect the valuation to be from bottom of 235 to top of 480. So the midpoint at about 358.
Wow, so basically Friday, that's why it dipped below 235 around 10 a.m. and the stock price V back above 235 around 1:30 p.m. and kept going.
I think so, but that's always the initial reaction when the stock dipped below its bottom line. You can't assume that Facebook won't dip below 235 again and remain below. If that's the case, then by that logic, the stock will never go below 235.
Exactly. I was about to say that. Also, in 2021, all year Facebook bought back 44.81 billion worth of stocks, including 19 billion in the fourth quarter, and the company still has 38.79 billion authorized to buy shares back.
Worth noting that the Q4 buybacks average is around $330 if you assume they bought back on the lower end, which is they probably did, meaning they believe Facebook at around 330 bucks is cheap enough. They didn't think it was gonna be like this.
And from the forecast, I believe more aggressive buybacks are coming for Facebook. And I also bought some Facebook, averaging right below 250 for about 4% of my account. So fingers crossed.
Keep in mind that companies always know how much they are worth, even though sometimes the market doesn't agree. But regardless, I think buyback value is a good MSRP for the entries.
So we both added because we like to get near bottom of the valuation zone. And we like the outlook for Facebook actually. Despite having a bad quarter, after all, how are you supposed to add when it keeps going up?
Exactly, so no zones for Facebook for this quarter. We have been scaling in small since the ER, so there's your zone.
Up next, we have Amazon. What a save after Facebook almost dragged the market down under.
Amazon blasted as high as 18% Thursday after hours and closed around 13% up on Friday. Check out the screen for earnings summary.
The massive beat is pretty much because of Rivian's gains, and of course, the cloud business remains to be this earnings season's main temple. Microsoft and Google both got good cloud earnings, and AWS for being the market leader, of course, it has to turn in a wonderful homework.
So despite revenue slight miss estimates, Amazon also announced revenue from ads for the first time. Ad grew 32% year over year during the quarter. This revenue was previously included in the other segment.
Quick question, I'm kind of confused. How did Amazon beat EPS by this much? 27 to 3? Did Wall Street not do their math right?
Yeah, nah, that's because the Amazon investment on Rivian causing the unrealized gains on the earnings. But overall growth in each segment is still pretty good, excluding the Rivian gains.
On that note, let's talk about the Rivian gains. So Amazon reported a profit of 14.3 billion for the quarter. 11.8 billion out of 14.3 is actually accounting from the Rivian stake.
Amazon holds about 160 million shares, so if we use the current Rivian shares cost around $60, we are looking at about 9.6 billion worth of Rivian shares. So compared to Amazon's market cap of 1.6 trillion currently, is about 0.6% of the entire company, so not a significant size.
But it made a huge difference for EPS this quarter. So if we exclude this from the EPS calculation, we're looking at about $8 for EPS, which is still a beat on the street estimate of 3.7, but would be a year-over-year decline from last Q4 of 14.09.
In other words, you can say that the street is right about declining EPS, but Amazon is not as bad as everyone thinks. But good thing to mention though, if you haven't noticed already, this earnings is calculated at the end of December. So Rivian was at about $100 back at end of December. So if Rivian can recover from current $60, Amazon will be taking an unrealized hit on profit for Q1 this year.
So looking at Amazon's Q1 forecast, revenue between 112 and 117 billion, which is lower than estimate of 120, and operating profit will be between 3 to 6 billion, also lower than estimate of 6.6 billion. So we can say that the outlook for Q1 is not great for Amazon, but it's not all bad for Amazon either. They are raising Prime from $119 to $139 annually.
Yup, personally, I won't be canceling my Prime membership and don't think a ton of people will because of the price increase. And also, AWS revenue grew 40%, which is another beat on estimates, like we mentioned in the beginning.
So how much is Amazon worth and where is a buy for Amazon?
So looking at full year valuation, we think Amazon should be at between 2,720 to 3,450. So the midpoint is around 3,085.
We believe that anywhere below 2800 is a pretty safe short-term buy. If you're looking to hold long-term in a few years, around 3000 to here is a pretty friendly zone to hold Amazon.
I agree with that. Tech stocks bounced back a little this week and closed the week up around 2.5%.
Dow Jones and S&P 500 also closed above 1%. Overall, not a bad week. For the month of January, the average intraday point moves for the Dow is roughly 400 points.
That's very volatile. But after the S&P 500 falling into correction territory, which was about 10% in the month of January, that pretty much fried all the high flyer from last year.
Yeah, look at Wayfair, PayPal, and Zillow, you name it.
The Fed has been and still behind the wheel for market sentiment and performance. The first rate hike in March that we've been talking about for so long is now a done deal.
Expectations have now shifted to as many as 6 rate hikes. The chart below shows the recent increase in expectations for the rate hikes in March, and interest rate dot plot is now implying that there is a 30% chance that the Fed hikes rates by 50 basis points at the March meeting.
I wouldn't be too surprised with the current labor market and economy. I think the Fed can be a little bit more aggressive, but that is what I think. Just throw us the worst possible scenario and let the market digest it. What do you think?
People are not going to like it, but I think regardless of what the Fed says, I maintain my opinion from the beginning that the market will sideways most of the year, and S&P up 10% from end of 2021 is still good with me.
All eyes will be on Thursday's inflation report. This is one metric that will determine how aggressive the Fed's monetary tightening will be.